Good morning, everybody, wherever you are. Welcome to the Economist virtual event that's focusing on the resilience of the financial sector after COVID-19. My name's Joan Hoey, and I'm the Director for Europe at the Economist Intelligence Unit. We have three excellent panels of speakers this morning to talk to us about the subject matter, and we've got plenty of time for discussion after the speeches. The event is being transmitted live on our YouTube channel. That's the Economist Southeast Europe events, and I encourage everyone listening to submit your questions via this channel. So this event will look in detail at the risks posed to the European banking sector by the COVID-19 crisis. And this will be the subject matter of the first two sessions in particular. But we will also consider the changes and potential opportunities that may be accelerated by this crisis. And that will be the focus mainly of the final session. Just before I introduce our two speakers for the first panel, just to set the scene a little bit, I will say a few words about what this crisis means for Europe's banking sector. The crisis does revive risks to the region's banking system because of deep recession. We're forecasting a recession of 8.4% in 2020 in the Eurozone. This recession and the inevitable associated rise in business failures will exacerbate the banking sector's problems of low profitability and high sovereign exposure. The problem of the doom loop, that's the mutually reinforcing link between sovereign and banking sector risk, remains because banks have increased exposure to domestic sovereign debt now compared even with 2010. In the last few months, policymakers have sought to protect the banking system from shortfalls in liquidity and have eased regulatory conditions to reduce losses. But there's a substantial risk to bank and sovereign balance sheets from the coming recession. One positive point, the European banking system was more stable going into the coronavirus pandemic than it was in the aftermath of the Eurozone crisis. NPLs were falling, Tier 1 capital ratios, that's stockpiles of excess capital within all banks, had increased, and the return on equity for Europe's banks, which is a broad measure of profitability, was also increasing. Also importantly, the establishment of the European Banking Authority has provided a unified banking supervisor across the euro area. And there's also a unified regulatory framework, albeit still in development, for European banks. But structural problems persist in specific countries in particular, particularly Italy and Germany, where bank return on equity and Tier 1 capital ratios are among the lowest in the euro area, and market concentration is far below that in neighbouring countries, which leaves smaller banks vulnerable to a reduction in economic activity. Now, I've already mentioned the European Banking Authority, and I'm delighted that we're joined this morning for our first panel by Jose Manuel Camper, who is the chairman of the European Banking Authority. And Mr. Camper is going to speak first and will be followed by George Zavos, Deputy Minister of Finance in charge of the financial system of Greece. So let me, without further ado, introduce Mr. Camper. Good morning, and thank you very much for joining us.
Good morning, John. Thank you very much for holding the event and for moderating the session, and of course for inviting me to the session. I really appreciate very much being here. As you said, the banking industry entered the COVID-19 crisis in a situation that was better than certainly the 2008 crisis in a number of dimensions. Particularly, you mentioned the level of capital, the decreased trend on NPLs, and also I will also highlight the liquidity conditions of the banks entered the crisis with a liquidity coverage ratio of 149% on average, when the regulatory requirements were 100%. As of the end of the first quarter, they remain at 149% already in the middle of the COVID-19 crisis, which highlighted to us also the important measures taken by the monetary authorities to help manage the crisis. The banks also showed a fair amount of resilience as we went into confinement and teleworking, 100% teleworking, and operations of all financial infrastructure, not just from the point of view of banks, but firms, work properly. There were moments of tension, but overall, I think the working of financial infrastructure proved to be resilient, which was a good sign. After a first focus on making sure there was operational resilience, and from the point of view of regulators of alleviating any burdens that were unnecessary on the operational capabilities of banks, on our side, we interrupted the stress test that we're in the middle of running for this year. We run them every years. So we thought that now was the time for banks to focus on managing the stress that we're going through rather than working or responding to a hypothetical stress relation analysis like our stress test analysis. We substituted that for transparency information that we provided at the beginning of June on the situation of banks entering the crisis, and we will run the stress test next year with updated scenario and similar methodology that was planned for this year. As we go forward, as you said, the banks were confronted with a number of challenges prior to the crisis. You mentioned profitability, and profitability, of course, return on equity. Profitability has been a challenge in the European banking industry overall. The return on equity has been below the cost of equity for the last 5 years, and this is likely to continue to be a challenge going forward as the economic environment has worsened, and at the same time also the profile of interest rates going forward is probably for lower for longer than prior to the crisis. Second aspect that the banks had to engage with was important technological transformation in an industry that was going through a significant innovation phase and structural changes driven by, broadly speaking, fintech and new technologies. Banks had to adapt to their business models to the new environment, make significant investments, and as a result of the COVID-19 crisis, that need has probably accelerated the rate at which customers are familiarizing themselves with new technologies, and particularly with telebanking and distance banking, at increase. So banks need to update their system even faster. And then the third aspect, which you also mentioned for particular countries, but I think it's broadly speaking applies to the whole of the European Union, is a significant structural change. There are pockets in which we think, as you said, profitability is low, but also pockets in which we think there may be excess capacity. And we need to go through a process in which good banks succeed, good banks excel in market share, and not so good banks either adapt their business models or orderly exit the market. And that's a process that's difficult. It's going to take time for it to develop. Now, in the interim, we need to manage the crisis. Here, as we go forward, there are 3 issues that for us are of particular interest and concern, and that we're carefully watching. The first one is the interplay between the economic condition and the exceptional measures being put forward by governments. Particularly, I'm thinking of moratoria, public guarantee schemes for exposures, which are probably more likely directly affect banks' balance sheets. We're closely monitoring to make sure that banks properly assess risk as they engage to reprofiling of their customers, and also as we assess how the different, particularly the public guarantee schemes, which in their nature are have been national initiatives. Of course, they differ by country. Sometimes they even differ by sectors or counterparties within a country. So how that will interplay with the working of the banking sector, how many losses will actually, if materialized, will end up in the balances of the banking sector, an area that we monitor closely. The second aspect that we are also very concerned and monitor as we go, given that, as I said before, many of these are national measures, that we do get proper functioning of the single market, and that cross-border flows, cross-border activities continue to operate properly. And then the third aspect is that banks do not forget in the middle of this difficult situation, which we are in the short term, the long term challenge. Here, I'm thinking particularly of areas I already mentioned technology, but we're thinking of particularly areas of ESG, sustainability, climate change. These challenges have not gone away. In many ways, again, they have become even more salient right now. And the third part, which I think is fundamental, is also cybercrime and financial crime more generally. We've seen as a result of the sharp move to telebanking activities that there's been a slight increase of cybercrime activity, and of course, as technology also interacts with telebanking activities, the likelihood for AML activities remains there, and they have increased. It's important that banks continue to be very prudent and very vigilant on those sides. So those are, I would say, the short-term challenges. I also speak about the long-term challenges. And as I said, the good news is the banks have been, up until now, being able to contribute to absorb the shock, the health shock, the critical health shock with large impacts on the economy. I think to adequate channel credit to the economy and liquidity and performing their role properly of assessing risk, it's important that they continue to do that as we go forward. And let me stop here, and I will be very happy to engage later on in the blogging. Thank you very much again for inviting me to be with you.
Thank you very much indeed, Mr. Camper. That's a really good survey of the issues and challenges for the whole banking sector going forward. I'm sure we're going to come back and pick up on some of your points. So let me turn now to Mr. George Zavos. As I mentioned, Deputy Minister of Finance in charge of the financial system of Greece. Mr. Zavos, good morning, and thank you very much for joining us. Over to you.
Thank you very much for the invitation, and welcome very much the Economist's e-conference today, where we can express some views regarding the post-COVID system. Regarding the pandemic crisis, Greece, as you've seen, Greek government has reacted at an early stage by adopting bold measures, and measured by the results, it has got, I think, it's quite successful in achieving its immediate goals. Regarding now the broader European situation, we have welcomed the measures that be taken by the European authorities, especially the ECB, when it launched the new emergency program, under which securities can buy securities, mainly government bonds. We have also seen the way that the supervisory authorities, and especially SSM, has made available a number of flexibilities and measures whereby we have seen flexibility for capital ratios, liquidity ratios, and enabling thus the banks to continue to channel finance the real economy, and especially to small and medium-sized enterprises. At the same time, other European authorities, the Commission, has also, allowed flexibility and suspension for some other rules regarding the accounting and also the state aid rules with regard to banks. It is true that during this crisis, the banking sector, banks are not a part of the problem, but it's probably part of the solution. Still, we should be quite careful, as you said, and Mr. Kamba, to monitor the ongoing developments. So whenever any risk pops up, we should be ready, to face it with the appropriate measures. Still, I think that we're in a good path with these measures, and especially at this period. The difference, this crisis from the previous crisis, the Eurozone crisis, is that the authorities at all levels have reacted at an early stage and in a quite coordinated manner. This means the ECB and the other European institutions, and especially looking very much forward to an agreement of the recovery fund that will be discussed these days at the European Council. Still, I think we have to bear in mind the important lessons of the previous crisis. And this, we should hit carefully these lessons in order to avoid their repetition. And I think one point that should be quite careful, and it's crucial for the euro area, is to avoid any regional fragmentation as the ones we witnessed it 10 years ago. We know that the periphery has been hit quite severely, and despite all the efforts, some countries still have not fully recovered, from that period. Another lesson of the Eurozone crisis, which I think it was a banking crisis and not so much a fiscal crisis, is there cannot be any monetary union without a fully functioning banking union. And this is a lesson to be taken up in the days to come and the weeks to come, especially by completing the banking union and adopting a fully fledged deposit guarantee system. Still, we know that financial markets and even having a fully functioning banking union cannot work without a capital markets union. But because the Eurozone and the banking union need a second edging, need a deep and liquid capital markets union in order to be able to channel and finance productive projects by, I would say, the surpluses that coming and existing in the Eurozone. It is a good time also, a year after this government has come into office, to make a first assessment of its reforms in the banking sector, and especially in what has achieved within these 12 months. I limit myself only to three reforms. The three reforms that I have tackled structural issues that have been, I would say, the Greek banking system for the previous years. The first one has been the adoption in a record time of the Hercules project, which is a securitization project aiming at least the current backlog of NPLs. Therefore, we're looking into midterm reduction of at least 35 billion. And we know now, with the given information, that at least the 4 systemic banks in Greece are joining the program within this year. We have been, despite the crisis, granted the authorizations, for state guarantees in some of the projects of one at least systemic bank. A second major reform that it was adopted only 2 days ago in the Greek parliament with, I would say, very important majority of 4 parties, is a reform pertaining to a corporate governance. It is quite, I think, a success, especially if one wants to see that as a companion to the other banking reforms, and also as a major boost for the confidence of the Greek capital markets and stock exchange. A third reform that will be forthcoming in the next weeks and will be adopted by the Greek parliament before the end of this summer is a reform pertaining to the law on insolvency and bankruptcy, therefore aiming at the creation of a unified bankruptcy law and thus at having a fully functional secondary NPLs market. As we understand, all these are important achievements, important reforms aiming at attracting investors at this crucial moment in the post-COVID crisis. Still, and to finalize my observation, I would say that in the years to come, the banking sector will be shaped at least by 2 visible trends that now they are ongoing. First is the digital transformation, which affects banks, and we have seen them, how they're reacting, I think, immediately to the COVID crisis. And the second one is the sustainable development and the green finance. So the efforts, the front-loaded reforms of the Greek government at aiming especially at reinforce the resilience and the competitivity of the Greek financial sector. And let me say also that we are strong support of the completion of the European Banking Union and also of the Capital Markets Union. And we think that is of urgency and importance in the weeks, I would say, even and years to come, to reinforce especially the European Supervisory Authority for Capital Markets, which is ESMA in part. Therefore, we'll have both companion of the SSM at this level, and therefore a major reinforcement of the European financial system, a major step towards European political integration, and especially a great support for Europe's and for Euro's international stand in the global financial markets. Thank you, and I'll be ready to take up any questions that may arise. Thank you.
Thank you very much indeed. Thank you, Mr. Zavos. So thank you, both of you. So you both raised very many questions, and we have a few questions that are coming in via our YouTube panel. I have a few questions as well, just to pick up on a few of the themes that you have raised. So I guess an obvious question is what happens to the banking sector if we have a second wave of the pandemic that is worse in the winter of 2020-2021, and countries are compelled to lock down again. And the recovery, which is already looking like it's going to be quite protracted, becomes even more protracted, and the hit to GDP is much greater. What would be the impact in terms of losses? Mr. Camper, you said that the decision had been made not to conduct stress tests now, to put that off until next year. But I assume that some stress testing, informal stress testing, must have been done with this in mind in terms of what happens if we do have further lockdowns. Is this something that you are able to comment on?
Well, thank you for the question. As you started by in your remarks, this is the question at this stage, and of course, you put it very well, because the fundamental channel is, there's a health crisis. The health crisis has an impact on the economic situation, and then as a result, that impact on the economic situation may be filtered to the banks. It's difficult for us at this stage to assess, how the health crisis will evolve and the impact that the health crisis may have on the economic situation, whether we'll go into a total lockdown or, like a very focused, specific restrictive measures where new focuses of the virus may arise. So it's too speculative. What we have done is we have done some sensitivity analysis, and I can report you a few numbers on that. As I mentioned before, the initial capital position of banks was relatively comfortable at the beginning of the year. They started with an average capital ratio of 14.9%, correct with Tier 1. That basically meant that they had about 300 basis points that were above capital requirements at the time. On top of that, the measures taken by regulators, by releasing capital buffers, both countercyclical capital buffers as an additional one, and the measures taken by banks by holding back dividend payments and other distributions to shareholders, that increased by another 110 basis points the buffers. And on top of that, then you have what's called the P2G, which, as you know, it's a guidance of Pillar 2, but it's not a requirement, which the average was 90 basis points. So the sum of all that is basically 500 basis points that banks had, as, if allowed to say, as additional capital before they break into any capital requirement. Now, we performed some sensitivities on the stress test, the last stress test that we ran, which was 2018. Basically, what we did is we updated the information of the data banks at the beginning of the crisis, the scenario of 2018, and then we increased the probabilities of default for those sectors more hit by the pandemic and those countries more hit by the pandemic. So The result of that analysis basically meant that, the capital erosion on average, may go down to about, could go in the worst statistic that we did, up to 360 basis points. We still left over 100 basis points of additional capital that could be used for increasing balance sheet. So banks have been doing in the last 3 months on average, or increasing RWAs on the exposure because they become more risky. Now, of course, that gives a sense that, on average, the banks could resist what looked like could be a severe pandemic. But of course, this is with the strong qualifications. First, is just an estimation. Second, the calculations that I'm giving you are on average. There is a distribution around the average, and I think there are weaker banks and stronger banks, as we said before, both in terms of their starting position, their business model, but also how they may be hit by the pandemic. It's not homogeneous across the union. So there could be some banks that may have some challenges. We don't think that will be systemic. We think that will have to be dealt individually, and for the national supervisors to be managing that. So that's a big concern. And then the third aspect is, as I mentioned in my initial remarks, the fact that there are all these measures being put in place by the government, public guarantees, foreign measures to try to revitalize the economy, and how will those play out? It's still, it depends on how the economic situation will evolve, but hopefully will help dampen a little bit. So, quick summary to a complex question: high uncertainty, first of all, relatively okay conditions to start with, but we need to remain cautious because, anything may happen.
Okay, thank you. Thank you very much. We're coming towards the end of our time for discussion. And let me see, we have a bit more time. So to come to you, Mr. Zavos, maybe you can say a few words about your assumptions about a second lockdown. Is the assumption of the Greek authorities that is not going to happen? Even without a second lockdown, obviously the banking sector is facing huge problems. The two things I wanted to ask you about is first about liquidity. Is that an issue anymore? I mean, obviously it was at the very start in the early weeks, but concerted action by central banks, which prioritize providing liquidity to banks, solve that problem. But could it become a problem again, do you think, at a later stage? And then probably more importantly, what about solvency problems? Do you anticipate that you're going to see a wave of business closures, business failures, which result in rising non-performing loans, which will then erode the asset position banks and raise the risk of insolvencies? Is this, and not just in Greece, but you can talk about Greece, but also more generally, is that something that you see as a major challenge going forward?
Yes, I would say that with regard to liquidity, but also to capital buffers, system, it's quite resilient, and situation is quite satisfactory, as well as regarding deposits. You've seen the liquidity that the Greece has got an easy access to international capital markets. It is also within a very, I would say, supportive European environment, especially since the Greek banks have full access to liquidity support of the ECB, and Greek government can raise easily, I would say, any type of financing, very low spreads from the international capital markets. Regarding the ongoing situation in the real economy, I would say we're following closely and monitoring the relevant developments, but we have undertaken all necessary measures in order, in very short time periods, the available liquidity from the Greek government and also from the European institutions to be challenged in and especially into small and medium-sized enterprises. Therefore, at this period, we're having all efforts taken in order to be able to resist as much as we can to any pressures, coming from any type, I would say, of the ongoing crisis. Still, as the supervisor, as Mr. Kamba mentioned, it's still, I would say, an early stage to know whether and to what extent there might be, any new generation, I would say, of MPs or of NPLs. When time comes and we have any indications, be sure that the Greek government will take, the necessary steps, especially in close cooperation with all our European institutions, regarding the banking sector. We have been working quite closely on all this, and our main effort is focused, as I said before, on reducing the current backlog of NPLs, and we hope that midterm we'll be able to bring it down on a single-digit numbers, as the Greek Prime Minister, has already declared quite some time ago. Therefore, having the Hercules asset protection scheme fully working and being not able also to be extended if need be, if there's demand from banks, we hope that we meet quite, I would say, comfortably several of our goals in addressing this thorny structural issue, which is the NPLs problem. Nonetheless, we understand, and as I mentioned before, the Greek banks will be challenged, especially by the ongoing, important transformations in digital sector, and they need, in the months and years to come, to be able to meet, I would say, the goals of profitability, and especially they should be able to play again fully their role as the main channels of liquidity to the real economy. My final point is that we're hands-on the relevant developments, and as we have proved up to now, there is a clear strategy regarding the addressing of the structural problems of the Greek banking sector, but there is a sequence also of the components of this strategy in order to be able to meet any future demands within always the bounds of the European policies. And I would say that the Greek government is fully supportive of any European initiatives that will be taken within, as I said, the banking union in addressing the issue of the NPLs in the near future, as well as in the capital markets union, which is quite relevant in addressing this issue. So I would stop here.
Thank you very much, Mr. Zavos. So maybe we can, this last point, come back to you, Mr. Kamper, and ask about the state of play regarding the banking union and capital markets union as well. I mean, this has become, I guess, even more of an issue now with this crisis. I mean, first of all, do you think we are likely to see more sovereign bailouts of troubled domestic banks in the coming period? I mean, we've seen that even in recent years, in 2019, in Germany, and before that elsewhere, despite the establishment of a single European entity, the Single Resolution Board, which is supposed to resolve bank insolvency under bail-in rules, we've still seen these sorts of domestic sovereign bailouts happening. Now, do you think we're likely to see more of that in future? What is the state of play at the moment with these institutions, and are they? When will they be fully functioning?
Thank you. Thank you for the question. I do think that the completion of the banking union and to make progress on the capital markets union, as Mr. Sabo said, are fundamental. And I think these are projects that I will say that there is broad consensus that this is fundamental. There is maybe difficulties in implementing the last parts of it, particularly the banking union. I think there's a well understanding that there needs to be progress made also on deposit insurance as a final pillar of the banking union. And the capital markets union, the Commission just requested this report, or actually received this report that was led by Thomas Wieser, on how to advance on the capital market unions with some good proposals, which I hope that can be taken on. On the specific issue that you asked about the resolvability of banks, here we do have a system in place. Is the BRRD, as you know very well, the Banking Recovery and Resolution Directive. It's a directive by definition, so therefore it leaves room both for national room for implementation as well as roles for the European level via the Single Resolution Board, as well as the national level for smaller and non-significant institutions. But that regulation needs to be applied. In the process of thinking of early applications, we have seen events in the last 2 or 3 years of banks being resolved on the BRRD and also being resolved on the national regulations. And part of the challenge that we have here is that, of course, when they go into national regulation, they go through insolvency procedure, and those are very country-specific still, and there are large differences in that area. I do think as we go forward, and as I said before, the situation is very uncertain, and we think that the bank system overall is resilient, but there may be individual instances of individual institutions that may run themselves into trouble. It is important that we resolve those banks, if necessary, in a quick and swift manner, without raising any issue of systemic concern. I think that would be an important challenge for both the SRB, the Single Resolution Board, if they need to do it, and it's their role, or for the national authorities jointly with the Commission that has to keep an eye making sure use of state funding, public funding, is proper within the rules of the BRRD. But we do have the BRRD, and it's important that that regulation is applied properly.
Thank you. To come back to another issue that was raised by Mr. Zavos, I mean, you emphasized, Mr. Zavos, that it's very important that we learn the proper lessons from the previous crisis, the Europe's sovereign debt crisis, if you like. Obviously, Greece was at the center of that crisis. So the first point that you made was that we need to avoid regional fragmentation and avoid a situation in which the European periphery, suffers most from this crisis. Now, some of this may be outside of your competencies, but we have the meeting tomorrow, which is going to discuss the European Recovery Fund. That discussion so far has been quite fraught, to say the least, and we have seen divergent opinions being expressed about how this recovery fund is going to operate, divergences between the so-called Frugal Four and the northern countries and the southern European countries. I mean, do you see this? I mean, first, I'll come back to you, Mr. Zavos, in a minute, because you raised it, and I wanted to ask you whether you think that this is a problem already during this crisis. But perhaps, Mr. Camper, you can say something about that issue as well. I mean, do you think that the southern European countries, particularly Italy and Spain, are particularly at risk, from the perspective of the financial system, banking sector, in this crisis?
Let me then, if it's the question to me, let me say a few things. First of all, there's, a perennial issue, I would say, in having a little bit more tense negotiations before taking such important decisions at the highest European level. as is going to be the days to come, the recovery fund. However, we need to understand a very important difference from all the other crises. There is a high political awareness about what is at stake, and the responses that we have already of the major Euro actors and countries are very, very encouraging. We never had such an immediate reply, first of all, of the ECB, and then of the proposals of the European Commission regarding the recovery fund in this important financing, especially to the extent that more grants will be made available in the immediate future, for the most hit countries from the crisis. That will be a very important step of addressing what I mentioned before, a danger of having a fragmentation on regional level. The other dangers coming from the previous crisis were the dangers of ring fencing national financial markets, which has raised the cost for industry whenever it has to function and to operate on a cross-border basis, but most importantly also has deprived the industries and the citizens of cheap financing, competitive financing necessary for growth and especially, for sustainable development. That's why the banking union completion, but more importantly now, the advancement of the capital markets union are of urgency and of essence. I would say, again, Europe needs a deep and liquid financial market in order to enable its industry to have cheaper and more competitive financing. Also, it is important to be able to recycle the very important surpluses existing in some countries to productive and quite, I would say, urgently needing financing in some other countries. And I would say also not about transfers of money, about investments. Also, is of crucial importance for Europe at the moment of very crucial international competition to be able to have an important financial and capital market center, since UK has exited the European Union, or is in the way of exiting. And more importantly, we are, and here I'm coming to the questions we have put probably at your conference, we need to meet the targets of a European Union, especially with regards to shaping a new society and a new economy. And here I mean, again, the issue of green finance and sustainable development, and also digital transformation. If we are able to act in this regard in the immediate future, we have made major strides for completing European integration, reinforcing Europe, making it an important actor, I would say a geo-economic and closely, geopolitical actor in an area, in a juncture of international competition and important tensions.
Thank you. Mr. Camper, did you want to comment on this issue, this, as Mr. Savos said, a perennial kind of north-south divide?
Well, first of all, let me agree with most of the comments that Mr. Savos said in the avoiding the risk of fragmentation, avoiding the risk of ring fencing, making sure that we have an adequate flow of capital within the European Union, within the single market. That's a fundamental part of the solution. And as we go forward, and I don't know if it's a perennial north-south conflict, I would say that there are a number of dimensions. We have small countries, large countries, surplus countries, deficit countries. It's not really just only a difference between north and south, but I do think that it's important that we manage this crisis, and Mr. Savos said that there's a high political sensitivity and awareness of the challenges of the crisis, and I tend to agree with that. That's a good starting point. We manage the crisis in a way that we come out together stronger. And I do think that we have to be careful, because this crisis has mutated very fast. In February was essentially a Chinese crisis. April and May was an Italian and maybe some European crisis. Now it's very much, I would call a Western Hemisphere crisis, in which we have countries like Brazil, Mexico, the United States. So this may mutate. There's a second wave. We don't know which way it's coming. But we do know that it's a health crisis with economic impact, and we need to work on it. I'm confident that the solutions of the discussions, I don't know if there are solutions, the discussions tomorrow will go in the right direction. I think that we need to build a European infrastructure to deal with the crisis, and the proposals on the table are good. So I hope they can move forward. And I do not think that there should be an identification of the crisis, because I don't think that the health crisis in itself has any borders. Really, that it doesn't.
Okay, thank you. We've only got a couple of minutes left now before we start the next session. So maybe you can give a very quick answer to a final question. I mean, both of you very much emphasize the role of new technologies and digitalization and the importance of that for the banking sector. So what does this crisis mean? I mean, in some ways we've seen, and we're going to discuss this further in another session, but in some ways it's accelerated, the crisis has accelerated digitalization when bank branches are shut and people are locked down at home. There's no other option. So we've seen an acceleration maybe of change there. But how, on balance, how do you see this crisis affecting this very big challenge for the banking sector? Will it accelerate change, or will it also prove to be problematic in terms of the investment that is needed in this area? Will that be will this crisis now be a constraint on the sort of and the size of the investment that's needed to bring about radical transformation? Just very quickly, just to hear your thoughts, because we've got 2 minutes, so you've got 1 minute each before we finish. Mr. Zavos?
Yes, I would say there's no denial that this crisis has accelerated already an ongoing transformation, especially the transformation to digital economy. Therefore, I think it would be important for the banking sector, and especially the financial sector, to embrace these challenges and to move speedily into adopting a fully functioning digital infrastructure. Obviously, we as a government, again, I have to say a few things. We're ready and supporting, especially the fintech in our priorities, and we're developing some design also innovation hubs. At the same also time, regarding the transformation I mentioned about sustainable development, we're very close. We're working quite speedily to develop the necessary infrastructure for having, I would say, more green bonds issuing. And here we have already underlined in legislation, and we very much welcome the support and the crucial role played by President Lagarde, especially in promoting the green finance. So we're facing courageously, I say, in a robust manner, these challenges of the banking system.
Thank you. We're out of time, really, but I will give you the last word, Mr. Camper, on this. Will it accelerate change, or is it going to cause problems in this technological revolution in the financial?
I think it has clearly accelerated change. On the good news, really quickly, on the good news, the banks have shown that they were sufficiently resilient to manage these operational challenges of the second quarter very effectively. And that's good news to start with. It has clearly accelerated the process. I think that process will come with challenges and opportunities and problems. They need to restructure their cost base faster than they anticipated. But I don't think that will be unique to the banking sector. I think that's a trend that will happen in many, many industries as a result of the experience. We are going back to people say, to the new normality. I don't know. Certainly, it's going to be different from where we came from, and that process is not just unique to banks; it's other sectors. And I hope that banks will be able to do their job as well, like other sectors have to.
Okay, thank you very much. Well, thank you both, gentlemen, for joining us for that first very, very interesting panel this morning. Thank you very much for your remarks. Thank you for staying for the questions and discussion. And we'll be moving on to our next session now. So thank you and goodbye.
Bye-bye.
Thank you for having us.
Okay, so we're going to move on now to our second session, going straight into the second session. We're going to look in more detail at some of the issues that have been raised in our first panel and look in more detail at the impact on the banking sector of this crisis. So I think we're going to be joined now by our next four speakers, and I will introduce those speakers one by one. Each of them will speak for 5 to 6 minutes, and then, as in our first panel, we'll have plenty of time for discussion afterwards. So let me introduce our first speaker, Athanasios Van Vakidis, who is the Managing Director and Global Head of G10 Foreign Exchange Strategy at the Bank of America. Welcome.
Thank you. I can start with some brief remarks and we can go into more detail later. I think the first point to make is that this crisis is not a banking crisis. So from this point of view, the banks is not the weak link today. And if anything, the banks actually are part of the solution, and many of the policy measures that have been introduced, they intend to support credit, to support through the banking sector, the real economy. Moreover, the banks started this health crisis, this global crisis, in a very strong position. To a large extent because of measures and regulations introduced since the last crisis. The banks have been well capitalized, well provisioned, very well managed, and they have been able, as a result, to deal with the economic shock very successfully. Having said that, the real economic shock continues, and the banking sector not only affects the economy, but is also affected by the economy. And although the banks are in a very strong position, a lot depends on how long the economic shock will continue. Will the recovery be strong enough? Is it going to be V, U, or L shaped? This will also affect the banking sector. The truth is that there is substantial uncertainty. Even if we are dealing with a temporary shock, and let's suppose a vaccine is around the corner, which is a positive scenario, we still don't know what is the permanent damage that has been done so far. A lot of the policy measures have just tried to keep everybody alive, keep companies surviving, save jobs. We don't know actually how much of this will be sustained, how many companies will be viable after the policy support ends, even in a positive scenario. Even worse is if we are dealing with a more permanent shock, if we have to live to learn to live with coronavirus for some time, then it is reasonable to expect that policy will have to adjust rather than trying to save jobs and companies, to try to see what is viable and what is not. Many sectors we have to shrink, many companies might not be viable, and as a result, this will affect the banking industry. The banking industry actually has increased provisions substantially during this crisis exactly to address this shock and this uncertainty. But again, it is a big unknown. Moreover, if we focus on the long term, the truth is that to a large extent, policies before this crisis after the previous global crisis, and now, up to an extent, they are trying to support the economy through financial repression. Low interest rates, zero or even negative in many cases, are keeping bank profitability. And the market consensus is that we're going to have low interest rates forever. Now, that's a very bad scenario for the banking sector, which I think today we're underestimating. Moreover, although the strengthening of regulation and supervision following the last crisis has been responsible to a large extent for the strength of in this crisis, the truth is that many times this has not been coordinated with monetary policy. So the right hand didn't know what the left hand was doing. We see this today as well. We are losing monetary policy. Actually, regulations, strong supervisions, quite often end up offsetting the possible positive effects of monetary policy. So looking forward, I think we need a better coordination between monetary policy and supervision to make sure that the two don't offset each other. And more generally, I think we need to take stock of financial sector regulation, banking sector regulation, to see what works, what doesn't. In some areas, we may need less. In some areas, we need more. And this will be important in order to think about how the sector contributes to the recovery. But not least, there are substantial long-term challenges. Right now, the market is pricing low inflation for this is not actually a given. And central bank withdrawal of monetary support has proved to be extremely difficult after the last crisis. Although some inflation will be good news because it can economists address the huge debts that have accumulated, the truth is that when we start thinking about the long term, high inflation will be bad news given the over-reliance of the financial sector on and markets on very low interest rates. So how central banks will deal with these challenges are extremely important for the financial sector, for the banks and beyond, particularly taking into account the sharp increase in debt levels that we had as a result of this crisis. So let me end here, and I'm happy to elaborate during our discussion.
Thank you very much, Mr. Van Vakidis. That's raised a lot of issues already to start the discussion. So let me next introduce James Longston, Managing Director and Head of EMEA Bank Ratings at Fitch Ratings. And I think you have some slides, don't you?
I do indeed have some slides, yes. So I will wait for those to appear on the screen. There they are, great. Well, thank you very much for inviting me to participate in this conference and share a rating agency's view on the outlook for European banks during this coronavirus crisis. We took a decision quite early on in the crisis to review pretty much all of our European bank ratings in about mid-March. And that really took place as the pandemic intensified and our own Economist forecasts were rapidly being cut and progressively being cut as the extent and the impact of the lockdowns became clear. So we now actually see the euro area contracting by around about 8% this year before recovering 4.5% next year and sort of approaching 3% the year after that. So a very steep contraction and a relatively slow recovery, I guess, would be the way that we see it. If you move on to the next slide, this one here shows the rating actions that we've taken on our core Western European bank portfolio from mid-March. And I think this portfolio will be the main focus of my comments today, but it's certainly true that the comments I make hold true for banks operating in Central and Eastern Europe and Southeastern Europe as well. So please bear that in mind. As a result of the first round of our review, we downgraded, I think, really quite a small number of banks. It only numbered about 10. And these were concentrated on banks where a few of our sort of key rating expectations were just not going to be met anymore, in our opinion, because of the crisis. So, for example, where we have an expectation of NPLs falling or earnings improving, let's say, baked into the rating. The highest profile downgrade at that stage was of Commerzbank. Around about a third of the rating actions, so the red bits here, this is where you put them on rating watch negative. These were banks that we characterized as having a low rating headroom at their rating level. And usually that was coupled with a sort of above average, we felt, exposure to more vulnerable sectors or more vulnerable economies. So as an example, major banks we put onto rating watch there were BBVA, Barclays, Danske Bank, BNP Paribas, Nordea, for example. A couple of them we've already gone back to negative outlook. Danske and Deutsche we've already put back to negative outlook. And around half the rating actions, which I guess is the orange bars here, these were negative outlooks. So these were assigned to banks where we felt they had more rating headroom, but clearly the sort of severity of the crisis that was unfolding presented risks to the ratings over a longer term, shall we say. And that really was as the either under our baseline scenario, that the economic outcome that I outlined earlier, or of course under the event that we hope doesn't happen, where lockdowns are reimposed and we get a second wave of infection and the economic impact is even worse. So it captured those sorts of risks. If you move on to the next slide, and bearing in mind, I guess, the topic or the subject of this section of the conference, I think this slide speaks best to what is the defense of banks to the pandemic, and my esteemed earlier speaker picked up on this as well, but here are a few numbers to elaborate it. So the blue bar is the development, and is using, with thanks to the EBA for their excellent risk dashboard data. So this uses the EBA risk dashboard. The blue bar is the fully loaded common equity tier 1 ratio development for banks that count for about 80% of the EU banking sector. So it's a pretty good portfolio. And you can see a pretty significant improvement from below 12% up to around about 15% now, CET1 ratio. And that isn't, and people often sort of say, oh, that's just mathematical trickery. It isn't mathematical trickery. That genuinely is improvements in solvency. I think the numerator in the ratio has gone up by about 25% over the time, and the denominator fallen only by about 5 or 6%, something like that. So that's a genuine improvement in solvency. But I think also at the same time, if you look at the red bar, we've overlaid impaired loans. There's been a very sharp reduction in impaired loans. They've halved over the period to less than 3% now. And that's a pretty good entry point, I think, to go into a crisis at that level of NPLs. Now, clearly, some parts of the region, particularly in southeastern parts of Europe, the NPLs are a lot higher. But as a generalization, the NPL situation is as good as it gets, I think, entering the crisis for large parts of the banking sector. So that's a pretty good first line of defense. If you look on the next slide, though, you then get what I would call the if that was the good first line of defense or second line of defense, the first line of defense isn't in such good shape, and that, of course, is earnings. The banks in Europe really have, really on the whole, pretty chronically low earnings, we think, as a sector in total. The weighted average return on equity at the moment is less than 6%, according to the EBA sample. And here's a selection of banks, around that average. So that is clearly a weak first line defense when we expect loan impairment charges to pick up quite significantly, as they did in the first quarter. And the reason for this is a combination of factors. Low interest rates, certainly. I think banks have probably underestimated how much cost cutting they need to do. They've constantly been trying to cut costs, but then incurring extra costs related to compliance or digitization. So I think ultimately, so the cost income rate has hardly moved in the last 5, about 65%. I think the pandemic will force banks to take a long, hard look at their business models. They will look at their use of real estate. They will certainly make further inroads into their cost bases, I think. And maybe it'll be a trigger for more M&A in the banking sector as well, I believe, as to create greater economies of scale. If you move to the next slide, my penultimate slide, and this is kind of a segue, I think, into my what happens next then for the ratings perspective, but particularly as the second quarter earnings looms. This is a selection of the largest banks, and it looks at the loan impairment charges in the first quarter, the orange dot, comparing that relative to the last 5-year average, the little green cross, and the range over the last 15 years. And I think what's striking is that it varied really very considerably bank by bank in the first quarter, which isn't really surprising. given the quarter came what I would say at a particularly awkward point in the crisis, where the trajectory was very uncertain, the mitigating factors of government support hadn't really been fully weighed out yet, and banks was basically struggling to calibrate their IFRS 9 models to take into account that. But what we can see certainly is a very different picture. I think Q2 earnings, which have just started with some of the Nordic banks, they will be somewhat informative. We'll certainly get a better picture of what revenues look like in the second quarter, because they will be actual numbers. We should, though, get a little bit more evening up and perhaps slightly better modelled outputs for their IFRS 9 provisions. So I think that'd be what we'll be looking at. But we don't expect real asset quality, actual loan losses to pick up really for several quarters yet. And so when the economic downturn, I suppose, genuinely bites and we get impaired loans. So if we move to the next slide, we've got a weak first line defence, a strong second line defence. What does that mean for ratings? Well, if you look here, this is the stock of our ratings. It tells you where we are now in terms of outlooks and watches. Since the first round, we've downgraded a few banks in Italy, following the downgrade of the Italian sovereign rating. A lot of them are back now on stable outlook. That's the blue bars, if you like. The downgrade of the Italian banks did indeed trigger a downgrade of a number of subsidiaries of UniCredit and Intesa in Central and Eastern Europe as well. I think I'd like to make the point, we do see, and this is a point that I think is interesting from this crisis, we do see the sovereign bank nexus is still very real. And we certainly see increasing sovereign indebtedness that's arising as a result of the crisis as a potential channel of risk for banks over the next year or several years. I think that's most relevant ratings-wise for banks that are at or close to the ratings level. And we've had one or two more downgrades as well. Société Générale, we downgraded BBVA. But if you just look broadly where we are now, we've got about 25% of banks on rating watch, about 60% on negative outlook. So a significant majority on negative watch or outlook. I think it will be several quarters before there's any sort of real prospect of widespread rating stabilization. And I think our view is that the risks are very clearly skewed to the downside rating-wise in the interim. And that's where I'll leave my introductory remarks and hand back. And then I'm ready to take questions as and when.
Thanks very much, James. That was really useful overview there. So let's turn to Guido Clary, who's head of Slovenia and the Western Balkans unit, lending operations at the European Investment Bank. Good morning.
Good morning, Joanna, and thanks for this invitation from Economist for this event. Actually, I have to say that we very much share Mr. Zavos and Van Vakidis' view that banks can be indeed the solution of the problem in this case. As the European Investment Bank, we are the investment bank of the European Union, and we have structured collaboration with banks and financial institutions very much instrumental to long-term investment projects, particularly for SMEs. Just to give you an idea, in 2019 we financed 7.3 billion budget, of which 8.8 billion outside of the European Union. Now, after 3 months of lockdown and strong policy intervention, we see that half of European Union and accession countries' firms face severe liquidity fall. Adding to the lockdown period, the subsequent recovery process might, we believe, lead to a cumulative gap in net corporate loans in the range of 1.9 to 3.4 trillion. And to compensate for this decline, firms will have to change their mid strategies, facing a hard trade-off between medium to long-term business prospects, therefore requiring more investment, or financial liquidity, and implying lower leverage. They can either try to preserve investment at the cost of higher leverage, potentially exposing them to solvency issue, or prevent substantial leverage increases by cutting investment. Now, with share of policy intervention being in the form of public guarantee schemes, firms will continue to have access to credit and thus leverage. On the one hand, it's true of weaker activity on NPL ratios will be lower for banks and higher for the guarantor, the sovereign. Now, let me focus on South and Eastern Europe, and particularly on the Western Balkans. We, as European Investment Bank, we conduct periodical basis a bank lending survey, and I wish to share with you some of the key findings of this survey. First, demand for loans continued to increase last 6 months. Prior to COVID-19 affecting the region, banks were expecting an increase in demand in line with the recent past, while post-19 expectations changed sharply and are standing in a contractionary area for the very first time in the past 6 years. Second, supply condition eased slightly over the past 6 months, in line with expectation recorded in the last quarter year. The COVID-19 induced crisis is expected to have a significant negative impact on supply condition over the next months, and therefore determining a sharp tightening across the client spectrum. Third, NPL ratios continue to improve, although less than earlier in the cycle over the past 6 months. Now, this positive trend is expected to reverse dramatically in the post-COVID-19 crisis environment, whereby the vast majority of banks expect NPL ratios to increase. Now, just allow me to give a short description of the European bank response, particularly in the Western Balkans. Despite the immense challenge created by the COVID-19 crisis, in the European Union itself, the European Union and the European Commission has shown through its Team Europe initiative real support for the Western Balkans. As part of this EU-led Team Europe initiative, the European Commission has announced 0.3 billion COVID-19 support package for the region, and of which the European Investment Bank contributes more than 50%. What we are doing, we are accelerating disbursement and ramping up our support for the healthcare and SME sectors for 450 euro. We are developing regional financial facilities for both the public and the private sector, which are currently addressing urgent needs, and they are looking beyond the immediate crisis. And above all, we are building a pipeline of investment that will improve the socio-economic condition in the region. A new euro 500 million regional facility will address urgent needs in the public sector, including the healthcare systems and other activities linked to the outbreak of the disease. This facility can also be used by the public sector to support the economic recovery, with a particular emphasis on small banks and credit guarantee schemes. Private sector is another important priority. The process of accelerating disbursement of funds and widening eligibility criteria for EIB financing disbursed through the banking sector. A new 400 million regional facility financing particularly SMEs through financial institution will reach out as many companies as possible. Now, the purpose of this facility is to support immediate liquidity needs and address investment constraints of SMEs and mid-caps, which are indeed the most affected by the COVID-19 outbreak. Thank you.
Thank you very much. Thank you, Mr. Kari. So the final speaker for this panel is Julian Klaus, who's head of O21 Exploration Engineering at BNP Paribas. Welcome to the discussion.
Good morning. Yeah, thanks. So for what it's worth, I had a unit at BNP Paribas CIB managing strategy-driven concrete exploration. Got a team of technologists, entrepreneurs, And we are strongly user-centered in what we do. So I've built new products and departments in many large corporations, in several industries, so automotive, IoT, travel tech, and now finance. I've got a slide deck, so I don't know if you can, great. So if you can move to the next slide, please. So I think we're all aware of these two modes in which business can operate. Exploration is the search of a new business, usually a word in which startups evolves. Exploitation is all about executing and optimizing a scaled business, usually where large corporations are. Both are important, and usually if you're a large corporation, you're heavily focusing on exploitation, so like banks, and still you make investments in exploration to prepare the future. Unfortunately, these two modes are very different. You need different types of people, different processes, and different KPIs. And exploration are actually very structured. It's data-driven, of course, but it forces you to be very clear upfront on why you do what you do and what you're going to measure. And at the core, they're aiming at managing uncertainty and extract value from this uncertainty, turning questions into opportunities. So if you go to the next slide. And talking about uncertainty, well, we've seen it's become more and more important. We talked about VUCA, volatile, uncertain, complex, and ambiguous world. Even more today. And in my humble opinion, it's a key competitive advantage these days to be able to respond to uncertainty. And we've seen many large and very successful corporations failing to respond despite tons of cash, very bright people, and market dominance. If you go on the next slide. So as a boxer said, everybody has a plan until they get punched in the face. And the idea here is to train yourself. If you haven't trained yourself in managing uncertainty many times before, it's very likely you'll fail the first time you face it. And in that way, the current crisis is very helpful for that, because it forced companies to train if they haven't done it before. This is why I believe it's important, if not essential, that large corporations, including banks, strengthen this ability to respond and their reflexes. It goes through creating new value proposition using methodologies from startups, of course, combined together with the unfair advantage of incumbents go-to-market channels. Of course, the outcome of creating new products and services is major to sustain your business, but not necessarily as important as the one you get in training the organization to adapt in real time, to measure market signal, to identify opportunities, and be able to execute in the world of uncertainty. Next slide, please. And execution is all. We know that. It's all about execution. Interestingly, what startups do very well is their ability to focus, like a laser. Okay. In the case of startups, being razor sharp is by design, driven by scarcity of resources, and it leads to stronger impact. We find the same kind of ability in some large corporations as well, by the way. It's not only for startups, mostly in digital natives like GAFAs, with the whole organization able to align very quickly and check OKRs if you want objective key results. That's one of the way to manage that. Some other large corporations have all sorts of legacy processes, organizational, business, tech, etc. And it usually deals with many markets. This legacy is good in a world full of certainty, but diluted light is broad and illuminates many. However, in a world of uncertainty, you burn a lot of energy by being broad and with limited impact. So later thinking comes with a clear vision, a clear strategy, and a way to have this vision and strategy being understood by all. Everyone knows exactly what to do in this context. If you go to the next slide. And the recent crisis triggered by COVID-19 showed us many things. The main one, I think, is pretty much everywhere in the world, human lives were considered more important than the economy, and this is a very good message in my opinion. There are other things that have impacted the business, and I just list 4 here, but I'm sure there are many more. And I've heard it a lot, even in the previous talk. First, the crisis clearly showed the interdependencies in our economies. Of course, we know about globalization, but suddenly we concretely discovered what it meant. When a country shuts down, it impacts the world, and we lived it. And we realized interdependencies that we didn't identify before. So there's certainly opportunities for the trade finance industry, but also financing in general. Second is self-service has become mandatory. We've heard that a lot as well. People at home still needed to work and needed to access systems and run the operations. Many have found that some systems were not ready. And many had to fix that pretty quickly, and they did it, which is very, very good. We're clearly in the digitalization of banks, which was in the roadmaps, but the crisis accelerated this trend and may open up some new distribution opportunities and self-service and personalization. Third, we've seen a shift in value. Suddenly, workers like nurses, doctors, or transporters were highlighted as key to our society. Still, their wages don't reflect this at all, and people noticed it. New values can create new asset classes. For instance, we hear a lot about energy transition, and I've heard it many times this morning, linked to restarting the economy. What it means to work on this energy transition. So shift in value implies the ability to better deal with what matters and what doesn't. And it's back to the focus concept. And finally, local may now be a viable, if not a desirable option. I hear a lot about investment trends moving to hyper-local. And people realized during the crisis that the field next door was actually producing vegetables they could buy. Distribution got shorter and actually worked during the crisis. Again, new product classes can be created together with some new distribution channels, almost like location-based in a way. Of course, we don't know if all this will persist over time. Still, it was a sort of a wake-up call, and I'm sure that some of new businesses will be built on these trends and new behaviors. And traditional players like banks are also embracing these to serve better the world. And next slide, please. So in times of great uncertainty, the most critical skill is to be able to adapt as conditions change. This is a kind of ambidexterity, focusing on surviving in the current moment while you also build toward thriving in a future that will look different. This is why I find incredible in times of a high uncertainty. Suddenly the organization is fully aligned and operates in new modes, improving its impact. Yes, it's triggered by an external event, but still, resilience and adaptivity is becoming a core business skill. The organizations that will survive will be the ones able to focus, be clear on what they do and why they do it. By embracing uncertainty and new modes of execution, iterative, focused, hypothesis-driven, this is how you really make your organization future-ready, not only in terms of product and services, but in terms of culture and capabilities. COVID-19 crisis has led organizations to do some strong introspection in reassessing who they are and how they operate, with people at the core, opening up some new ways of creating and delivering value. And as a conclusion, eventually, isn't culture defining a company much more than what it offers to the market? And could this cultural shift of being at ease in dealing with uncertainty be the new normal? Thank you.
Thank you very much, Julian. Obviously, it's a good segue into the next session as well, but I think it's good to raise these issues in every session and for every panel, and we will address some of those things. And maybe we can start actually with the point you closed on about uncertainty, which is the big question that's facing anybody who's trying to forecast what is likely to happen as a result of this coronavirus crisis, and every business and sector is confronting this problem. So I wanted to start by asking all of you how your assumptions have changed since the start of this crisis. So I guess, pretty much everybody started out maybe with the view that this was going to be, in terms of 2020, a tale of two halves, that we're going to have, this huge shock and huge contraction in the first half of 2020, and then we were going to see, inevitably, given the size of the contraction in Q2, a big rebound, at least in quarter-on-quarter terms, in Q3, and then a gradual recovery. So, to what extent, have you revised your assumptions from the start? How's that affected your forecast, and how do you think that the banking sector is doing much strategizing and kind of more long-term thinking at the moment, or has it all been so far about reacting to the shock? I think a few of you raised this, particularly Mr. Van Vakidis in his introductory remarks. That this is the big uncertainty, and actually we could be living with this for a long time. A vaccine's not arriving anytime soon, and even if it does, is that going to be effective? So that's my first question, really. Could it be that actually we're likely to see much more far-reaching changes in the sector and much more damage, maybe, than people anticipated at the beginning? So maybe I'll come back to you, Mr. Van Vakidis, since you raised this as well. What are your thoughts now?
More bearish actually than the consensus on the recovery. We have seen some strong data recently, but this is just because of base effects exiting from the shutdown of the global economy. It is the first time we put a large share of the global economy in an induced coma, and as we move away from to see a temporary improvement in the data. However, the question is, can we really go back to pre-crisis levels of production if the threat of the virus remains? And the answer is negative. As long as the health crisis continues, many sectors cannot really go back to operating at full capacity. And we just don't know when we will be able to put the virus behind us. We don't know how sectors need to adjust to a more is still there. And as I said earlier, as long as the real economy remains weak, if we are in an equilibrium in which output but stabilized in a weak level, kind of like on an L-shaped of recovery, with any loosening of measures, bringing back infections, so keeping economies operating below capacity, this is not a positive scenario for most sectors, including for the banking sector. And in addition, although monetary policies are supportive in this case for nominal assets, for financial assets, for money, they limit how much actually this rally can support economy. And low interest rates forever is not a good thing for the banking industry. So this uncertainty is actually a tremendous problem, and I'm concerned that the risk rally we have seen, to a large extent because of the massive policy support, might some complacency because the real economy is still suffering.
Thank you. I'll ask you in the order in which you spoke. So, James Longston.
Yeah. So we have forecast-wise, yes. If I look at I guess when we're doing most of the forecast for how we think banks will perform, we do pin a lot of our forecasting on our economics team's colleagues' forecasts for important factors like GDP development and unemployment, house prices, those sorts of things. This year, I think, has been highly unusual. We entered the year, for example, expecting the Eurozone to grow by about 1% this year. We're now at -8% this year. And I think we've revised our forecast something like 4 or 5 times probably from about middle of March onwards. So unprecedented level of revisions to our forecast, really, as we grappled with what I think our economists call lockdown economics, which the economics of lockdown and what that means. So that's been pretty significant level of revisions. You asked a question, I think, about banks. Are they in a strategy or coping phase? I think banks are very much hitherto, really up until around about, have really been dealing with just the near-term implications the pandemic, going from the mundane or the operational side very on about working from home and branches and head office working from home, etc., that sort of thing, and how to deal with recording telephone calls if you didn't comply with MiFID, that sort of thing. I think they're now at a stage where they're starting to look a little bit more beyond that, but I wouldn't say the sort of strategy-wise, I'm expecting we're seeing any voices of sort of absolutely transformational strategies going to come out of this. I do see more a sort of an acceleration of themes that are already there. So the classic digitization, yes, this is probably a catalyst to make this happen faster. Yes, they've been needing to cut costs. They're realizing that interest rates are here, lower for longer. Costs will probably have to be cut more. They'll probably have to cut them a little bit faster and a little bit harder, but they won't need as much real estate, I suspect. So I think it's probably, strategy-wise, it's more of a catalyst to accelerate themes that are already there. I think we could see more M&A, but I don't think revolutionary strategy changes are going to come out of this. Really, it's what was already there done quicker.
Thank you. Guido, do you want to comment on this?
Yes, thank you, Joanne. We need a considerable number of European firms are likely to reach excessive levels of financial leverage as the crisis unfolds. And as a consequence, a large share of EU firms could start the recovery period with deleveraging pressure. This, in turn, would have negative consequences on these company abilities to carry out investment plans. And lower investment would reduce demand and therefore also reduce revenues, which is another adverse feedback loop. Liquidity shortfall and much lower net revenues resulting from a period of exceptionally low activity will sure impair corporates' capacity to service their loans and therefore result in increase in NPLs. And on the financial system, too elevated NPL ratios could trigger a repricing of funding conditions of banks. Anyway, this time, and this also was said before by other speakers, systemic risk should be more contained than at the occasion of the previous financial crisis.
Thank you. Julien, do you agree with James's point that this crisis is more likely to be an accelerant than an accelerator of pre-existing trends rather than something that is going to usher in something completely new?
I agree indeed, especially short term versus long term. The banks have reacted to the crisis and they have reacted well, in my opinion, very well, and it forced the pace of this digitization. Still, it's all. I think the thinking about the longer term is now coming to people's mind and say, okay, the world is changing. Not only is changing, but by definition, by nature, uncertainty cannot be predicted. Okay. And that's the hard thing. So I usually tend to say, the best way to predict the future is to create it. So it could lead to some new value propositions, new positions, enabled by either the new behaviors or even technologies, because we haven't talked about technologies, but some technologies are now mature. About artificial intelligence, or if you look at technologies such as blockchain, and you've got the central bank digital currencies coming in, etc. So maybe it'll be a trigger for something new coming in, and people will create new things. So I think it's a mix. I fully agree it's reactive and improving the pace of digitization, but it could open up some new things. And if you look at the last crisis, it created some of the big leaders of today. If you look at Uber or Airbnb, and these kind of players, they actually were built in the previous crisis. So we'll see. And again, the best way to predict the future is to build it.
Thanks. So a few questions have come in on our channel, and one of which is, are we heading for a sovereign debt crisis? Not this year maybe, but further down the line. And what about this question of the so-called doom loop, this interconnection between sovereign risk and banking sector risk? Is that a bigger problem now, perhaps, than it was in 2010, or less of a problem? Anybody like to comment on that?
Yeah, I'll pick
Maybe
up on that
I
one.
can.
Okay, let's start with Mr. Van Vakidis and then James.
Yeah. I mean, is that as a result of the COVID-19 crisis, every single will end up with much higher debt levels. In the case of the Eurozone periphery, we are starting with already high debt levels. And if we take the ECB forecasts, Italy will reach 160%, in Greece 200% of GDP, Italy, Spain about 130% of GDP. These are huge debt levels. Now, the real bazooka in this crisis in Europe has been the ECB's PEP program, which has allowed the ECB to ignore the capital gain. But this is temporary. Next year, or at some point after the pandemic to end, and at that point, it has to go back to the capital key. So there is the question, what happens to the periphery spreads after the PEP program ends, and the ECB cannot continue supporting the periphery because of the capital key. How can the periphery reduce the debt levels from much higher ratios than before this crisis? Reduce them to pre-crisis levels, we're going to need massive austerity, not 1 or 2 years. We're about 10 years of austerity measures, which politically is impossible. And in any case, the fiscal rules, which now have been suspended, will kick in. So I'm not saying we're about to have a sovereign crisis, but all these questions, I think, will be very much relevant for markets after we end up dealing with the pandemic.
Thanks, James.
Yeah, I'm not a sovereign analyst, so I'll leave the sovereign angle, direct sovereign angle, to one side. But I will pick up on the sort of sovereign bank nexus, because obviously I look after bank ratings, so I do care about that sort of thing. We do think that the sovereign bank nexus, as I said a little bit earlier, is very real and exists and hasn't been broken. In rating terms, I don't think we rate any bank in Europe above its sovereign of domicile unless it's owned by a stronger foreign shareholder, then that can be rated above the sovereign. But banks rated on their own merits, if you like, their own financial strength, we don't rate any of them above their own sovereign domicile, and that largely reflects the fact that obviously the huge exposure they have to the local economy, just by lending into it, but also their large holdings of sovereign debt. It does vary, but still quite large holdings of sovereign debt. And there's quite a lot of academic literature that suggests that there's a sort of positive correlation between sovereign risks rising and bank holdings of debt rising. So as the sovereign gets weaker, banks tend to have taking on more sovereign debt as their risk-free asset. So that's direct link, which obviously can lead to solvency, correlation between the solvency risk of a bank and sovereign indebtedness. But also there's the liability side of the balance sheet. I think people forget that when sovereign risk premia increase, it tends to feed very directly through into bank funding costs. In an extremely extreme situation, it can feed even into sort of deposit stability and things like that as well. So we do still see that link as very real. Clearly, if there were sovereign risk off situations, it would feed through into the valuation of securities on their balance sheets. So there's accounting rules that can help there, but it clearly affects the value of that, and it affects their sort of liability side funding access and costs as well. So we think it's real, still hasn't been broken.
Thank you very much. I don't know if you wanted to comment very quickly, Guido, about the situation in the Western Balkans, apropos this question, where obviously in many places, maybe say the biggest country in the region, Serbia, the public debt to GDP ratio is much lower and has actually come down substantially in recent years to about 53, 54% of GDP, but is now likely to rise about 10 percentage points this year as a result of the hit to the economy and to the public finances from the pandemic. Do you see any issues here in terms of financing for these peripheral economies?
Yes, Joanna, I think for us, sovereign debt in the Western Balkans is indeed a reason of concern. We are very much focused to preserve capacity of countries to take and use their debt in a very useful way. To this regard, I have to say that our recent operations are very much based on the utilization of external mandate, which is a guarantee provided by the European Commission to support public sector, particularly public sector project in this country. So, I mean, we are very we think that generally finance provided by European Investment Bank is indeed and it is it for the long-term development of these countries. You mentioned Serbia, which is going through a very important development phase, but also the other in the other Western Balkans. Very much the necessity to guarantee that long-term investment will have a real impact on the economy and on the life of the citizen. Generally, for us, as the European Commission bank, we want to let these countries understand the importance to be closer to the European Union, and which are building bridges, building motorways, which are the steps that will be taken to discuss an enlargement process and an integration with the European Union.
Okay, thank you. Thank you very much. Now, thank you very much, all of you from the panel. Thank you for your introductory remarks, for your answering all those questions. We've come to the end of this session. So thank you again for joining us today. And we're going to disconnect now because we're going to have a short break, a 10-minute break, and we're going to restart the discussions in 10 minutes. Thank you very much indeed, and have a good day. Bye.
Thanks. Bye-bye.
Bye.
Thank you. Goodbye.
Bye. Hello, everybody. Hello, and welcome once again to this Economist virtual event on the impact of the COVID-19 crisis on the financial sector in Europe. For our final session, we're going to shift the focus a little bit to consider how new technologies are reshaping the financial sector. Before COVID-19, retail, corporate, private banks were already under pressure to deploy new technologies to compete with big tech firms, other payment players. And after the pandemic, after the crisis, the move to digital banking and the introduction of new technologies seems more urgent than ever. To talk us through some of the changes that have already taken place and that are likely to take place in future, we've got four excellent speakers who are all at the front line of these changes that are taking place and likely to take place. So we have four speakers. They're all going to speak for 5 to 6 minutes, which will allow us, if they're disciplined, plenty of time for questions and discussion afterwards. So I'm going to introduce each speaker in turn, and as I said, they'll speak for about 5 minutes. So the first speaker I'm very pleased to welcome for this panel. The first speaker is Demosthenes Anagnosopoulos, who is the Secretary General of Information Systems of the Public Sector at the Ministry of Digital Governance of Greece. Welcome. And over to you.
Hi. Yes. Yes, I have the floor. Okay, hello. At first, I would like to thank Economist and especially Ms. Vakidis. Can you hear me?
Hello, what I can see on the screen, Mr. Anagnosopoulos, but we're not hearing you at the moment.
Can you hear me?
Yes, you are on the air.
Okay, so shall I begin?
Yes, please begin. Please begin.
Okay. I'd like to thank Economist and especially Ms. Athanasios Van Vakidis for her kind invitation to participate as a speaker. And as you may all know, the economic impact of the pandemic on the market and public finance cannot be estimated with precision at the moment. And we're talking about a dynamic process that is in full progress and one that we have never experienced before. And if we had solid data at this moment, we cannot say that it will be valid in 3 or 4 months from now. We just cannot predict the global spread out of the pandemic. And in this volatile environment, we are required to shield the economy and the market against the inevitable shock caused so far. And as you may know, as the Ministry of Digital Governance, we have succeeded to do so to the best of our potential in the last few months, substantially contributing to the digital transformation of Greek public administration in an agile yet carefully designed way. Now, the launching of the national portal gov.gr is a concrete example. Gov.gr provides now almost 575 digital services to citizens in a unified way, accessible also from mobile devices. And we've also used web banking for user authorization purposes. More than 5.5 million citizens have used gov.gr in the last few months. And except from that, we have also digital, paperless prescriptions introduced for the first time in Greece. And so far, we have more than 2 million prescriptions issued in a paperless way. This gave us the opportunity to succeed in prohibiting citizens from making unnecessary visits to their doctor during the pandemic. You may be very much aware of the benefits of Fintech to e-government. These are very well documented, such as reduced economic costs, time and complexity, reducing bureaucracy, discretionary power and corruption, and also increased automation, transparency, and auditability, and accountability also of information, and the trust of citizens and companies in governmental processes. All the above, along with the services that significantly improve the everyday life of citizens and also facilitate entrepreneurship, consist concrete parts of our national strategy on the state's digital transformation, introducing of new technologies in all forms, and also, I would say, a manifestation of economic and social life. The Ministry of Digital Governance and the General Secretariat of Information Systems have shouldered a substantial part of the burden of implementing this strategy. And let me give you some concrete examples which may not be so far known. The first is interoperability. Now, our Secretariat is a Information Center for Public Administration. We gradually assemble all the main systems of the government and ensure that they operate and maintained in a uniform way. This is the G-Cloud that we so far have developed and unified. Now, the key tool to serve citizens is the Interoperability Center. Through this center, its public service may automatically receive data that refer to a citizen from any other public authority using web services without the citizen himself or herself having to provide the respective documents and certificates. Let me give you an example. The tax clearance, which is known in Greece as forολογική ενημερότητα, this is a certificate which is a very characteristic. This is a public document issued by a taxation office to be presented by a citizen to another public authority, usually for him or her to get paid. Now, 3 months ago, the automatic extraction of all data and the issuance of tax clearance certificate started, and now citizens and companies not to produce this certificate for them to get paid. This capability was first given to the Greek Parliament and then now has expanded to all municipalities. And we expect that until October, it will gradually cover all public authorities. Now, the purpose is to make it possible to automatically extract such a certificate and also avoid hundreds of thousands of tax clearance declarations annually. And this is a small example. In the last months, almost 800,000 citizens have applied for the undeclared square meters of their properties to municipalities without them having to produce any further documents. We have given the possibility to many citizens not having to declare to taxation offices their marriage or divorce, birth, or deaths. And also, we have ensured that pension systems are regularly updated for all these life events. In last week, we had almost 400,000 citizens which applied for a program of the government which was entitled Tourism for All, without them having to provide any documents or certificates. Our results concerning interoperability are very important. During the last months, we have an increase of 270% compared to the last year for the public authority bodies joining the Interoperability Center. Now, this may sound to be evident in other countries, but this was not the case so far in Greece. Also, during the first semester of 2020, we had almost 7 million calls for providing data from public authorities, from other public authority bodies, which is an increase of 220% compared to the first semester of 2019. This means that 7 million visits were not made to public authorities from citizens to get any certificate or document that they needed. And that's the first case. The second case concerns digital payments. We have given the capability to provide an application which is called e-Parávoli in Greek for allowing the direct online payments made by citizens and companies to the government. During the first quarter of 2020, we had 1.3 million payments for almost 87 million euros. During 2019, we almost had 300,000 million euros, and we expect to exceed 350 million euros in 2020. That means that countless visits to tax offices have been avoided this way, and also saving thousands of man-hours using the capability to provide online payments through this application. A project which is not well known so far is the Know Your Customer project. You know, in Greece, following the European regulations, banks ask their customers to update their personal details and also their contact details at a very regular time basis. Now we proceed with the automated update of these details by interoperating among the Citizens Registry, Ergani from Ministry of Labor, and also the Independent Authority of Public Revenue with banks. This with the explicit consent of the citizens. Now, the Know Your Customer project will relieve millions of citizens from their obligation to regularly visit banks and provide documents and certificates to update their data. This is a major transformation of the way that we interact as citizens with banks. It's a concrete and very successful example. I think that it will prove to be a very successful example of interoperability with the citizens' explicit consent, I say again. The fourth case is the e-invoicing. Now, our secretariat, the General Secretariat for Information Systems of Ministry of Digital Governance, and also in cooperation with the Ministry of Finance, implements e-invoicing under the framework of public contracts. And in this project, public bodies will be able to receive directly electronic invoices from their suppliers, national and international suppliers, under public procurement. This is a B2G service. This action started with transposition under national law of the European Directive for the issuance of electronic invoices in the context of public procurement, and in cooperation with all relevant ministries, which I may not have to say again which they are. The national format of the electronic invoice was determined, as well as procedures for receiving, processing, and payment interoperability and other technical details. Now, GSIS functions as the sole receiver of the electronic invoices of public procurement for the whole of the Hellenic public administration, and as a router of in the competent contracting authorities and contracting bodies. And their received electronic invoices will be forwarded to the public authorities, and of course they're based on the relevant directive of the European Commission. Now, concerning B2B invoices, the respective system is currently implemented, as you may know, by the Independent Authority of Public Revenues, ADE, and it will be hosted in the GSIS central infrastructure, easing the further interoperability and validation of data regarding the responsibilities of businesses towards the tax administration. The fifth case is teleworking, which is also mentioned in the program. Now, business continuity is very important. It was our primary concern, of our ministry's primary concern. Except from giving the capability to almost 15,000 employees of both our ministry and the Ministry of Finance and the IAPR to have access to their webmail from their home. And we have also created a substantial infrastructure for VPNs, which is virtual private networks, to ensure the network access to the confidential information systems through teleworking, according to all best practices. And we have done so also for public authority bodies who do not have such infrastructure. And our ministry gave the opportunity to have a secure connection, network connection, for almost 10,000 employees of public administration with zero cost for more than 3 months, which is a kind offer also from OSE. Now, teleworking to prove to be a very successful experiment for the first time in Greek public administration. And it, of course, was the first time that we had teleworking as a major practice in Greece. I had myself the opportunity to make a poll concerning business continuity for this period among people from both the public and private sector, especially concerning technical aspects. The result is that what I have found is that both business continuity, as you may know, was ensured. Networks worked, and also telecommunication lines proved to be also consistent. And we also create both infrastructure and digital services in almost no time. We got an increase in productivity for at least technical people, which was close to 15, as I understand from the people that have myself spoke to. And it was also possible to follow deliverables and timetables and prove to be both productive and efficient this difficult hour. Now, I choose to close my speech with an equally important issue, which is the number of digital services that are developed and also the higher the number of cybersecurity risks emerge. Our mission, both at GSIS, the Secretariat for Information Systems of Public Administration, and also the mission of the Ministry of Digital Governance, is to safeguard data which are hosted at our data centers. Now we apply this in practice through the adoption of best international practices, upgrading unified government cloud, and the continuous effort of our staff at the Secretariat. However, to be also possible to respond efficiently to scenarios that may emerge, our aim is to establish a new disaster center in the forthcoming months, which will operate simultaneously with the already existing data centers. And this way, in this active way, we'll promote business continuity according to international standards and further promote the continuous operation of critical systems of public administration. Let me conclude by saying that the resilience of the financial sector is positively correlated with the digital tools that we have available. The more and better digital tools that we have, the more we can facilitate the financial sector to successfully address the challenges, of course, based on our political will. Now, I present some cases that our Ministry and GIS implemented in cooperation with the private sector and which significantly contribute towards this direction. Of course, there is still much to be done. However, over these 12 months, we have proved that when the political will is there, when the required knowledge is available, and sound planning and decision-making take place, and everything can be done, even Greece's digital transformation as a state. Now, thank you for your attention. If I exceed the time, sorry for this.
Thank you very much. Thank you for those insights into the various initiatives on digitalization by the Greek government. Our next speaker is Georgios Karamanolis, who is the co-founder and CTO/CIO of Crowd Policy and the chairman also of Hellenic Blockchain Hub. And I think you have some slides.
Yes. Thank you. I would like to thank you or the organizational committee of this extraordinary event, and specifically Mrs. Passaridaki for inviting me to be an active participant of this event that I think is organized in the context of a global context of the overall discussion for digital transformation, financial technology innovation, and the opportunities that can be utilized by the banking sector.
That's better.
Okay, I suppose you can hear me. Can
We
you hear
seem to
me?
be having some problem with the connection here for Mr. Karamanolis. Shall we try one more time? We're having problem hearing you, Georgios. So try one more time to see if we can.
Yes. Can you hear me?
Maybe you could start your remarks again.
Yes. Now, can you hear me? Yes.
Please go ahead and start.
Yes. Yes. I think you can hear me, right? Okay, so I would like to thank you all, the organizational committee of the Economist events, for inviting me to this extraordinary event regarding financial technology, resiliency, and the opportunities for the banking sector. I think this is a great event with great speakers and great audience that is organized in the global context of a discussion that has to be developed about digital transformation, financial technology, and the opportunities. And I think there is a great opportunity also to enable, to motivate and support the business community in Greece with ideas, with methodologies, and inspire how to tackle the pandemic and the coronavirus crisis at all levels. And of course, I would like also to thank you for the opportunity to share with the great audience of the Economist event our experience and our innovation journey, collaborating with banking sector, government sector, and big organizations in Greece. Innovation journey that started, if we could move to the next slide, 5 years ago. We started in the middle of financial crisis in Greece 5 years ago. We started, we could move to the next slide, if possible. And we have started from 2 founders. Now we are 35 in, and try to provide services in banking for banking sectors, for government. And I was really impressed about the projects and the initiatives that the Greek government has been implemented. And I think all these initiatives are in the core of the discussion about financial technologies and the support of a resilient society and a resilient economy. For example, it is very important to utilize banking services and digital services from the banking sector, and the collaboration for the banking sector and the private sector. And the example of GovGR and the integration for Know Your Customer processes is a great example for this direction. We could move to the next slide, and let me introduce briefly crowd policy. So we started from 2 founders, and we have collaborated with an extensive network of organizations in Greece and abroad. We are trying to provide services in 3 different sectors. The first is related to digital transformation for the government. The second is related to digital innovation and financial technology for the banking sector. And the third and the most important, if we can go to the next slide, is related to innovation and how we could create innovation and enable and support the local innovation ecosystem and the local human capital in Greece, in order to collaborate with the organizations. And I will talk about some examples with the banks, and create added value services. If we could move the next slide. Here is a photo of our offices, but at the next slide you can see how we tried to address all this coronavirus crisis by working fully remotely, and we have been using a series of collaborating tools and business options and crowd policies, so without the geographical and spatial constraints. So we are trying to stay active and to stay with our clients and support both the government, the local government, and the organizations to innovate and utilize digital tools and services. And I strongly believe that the digital innovation companies, we all have the means to train and support the society and provide the tools in order to encourage and inspire as many possible as we can. To the next slide, I would like also to share with you some important moments regarding innovation ecosystem in Greece. Okay, we have organized 30 hackathons and innovation accelerator programs in Greece. And the most impressive is that we have collaborated with a huge networks of startups, developers, designers, and everyone understands how difficult it is to find developers in order to create digital services, both for the public and the private sector. In Greece, we are very happy because a great human capital and ecosystem exists, And if this human capital of developers who collaborated, for example, with the banking sector, it is impressive how the results will be impressive. So to the next slide, we have meet all this community in Greece with 5,000 developers and 500 startups participating to our initiatives. And recently, to the next slide, we have organized a remote innovation contest in collaboration with the region of Attica. A lot of applications have been developed from startups all over Greece. And I would like to mention that half of these applications were related in one or another way with financial technologies. For example, we have applications and business models participating to this innovation contest that were related to e-commerce, to contactless payments, to blockchain technologies, even know your customer processes that could be used by the public and the private sector. And I think it is an important, let's say, aspect of the conversation, because financial technology is something more from working with the banks at the core banking layer, or discussing only for payments. Financial technology is more than that, is related on how to apply advanced information systems, the experience of the banking sector in order to address social issues and business issues, and transfer of this experience in sectors of economy and society. So if we can move to the next slide. Visa Innovation Program is one example of this concept. Is a great example for the opportunities for the banking sector to develop fintech innovation and collaborating with startups and co-create new services in different sectors of economy and society. We have collaborated with Visa organizing the accelerator program in Greece, the second cohort, and this organization has been implemented fully remote during the lockdown period. And we think also, if we can move to the next slide, that the conversation, and I personally and my company loves financial technologies and all these relative concepts, both at the technology and at the business level. We think that the fintech conversation has moved from the banking sector, and we can exploit new services and develop all these ideas utilizing the banking infrastructures in different business cases. For example, for agriculture, for culture, for tourism. So the drivers, if we can move to the next slide, of this discussion are very different and create advantages for the banking sector in order to be competitive, to be resilient, especially during this difficult era. Okay, we have big techs in a global landscape that provide digital services, but also provide financial technology-related services. So we have to think how the Greek banking environment and the international environment of big banks or smaller banks can collaborate with startups in order to be more agile. The second driver is related to open banking and PSD2 regulation. I think it is a very, let's say, innovative legal framework, because it provides the opportunity for the banking sector to externalize the services and collaborate at the technical level and at the business level with third-party service providers. Some other examples are related to the opportunities for the government to collaborate with the banks. And it is something that Mr. Anagностopoulos has been referred to. It is a great example for the gov.gr digital service portal to utilize KYC processes and automate through interoperability layers the collaboration with the banks. It is something that we can fight bureaucracy and make the digital services in Greece more accessible. We can go to the next slide. So we are talking about not fintech and core banking technology and only, let's say, old mainstream concepts, for example, fraud detection or payments, etc. But now I think the conversation is about fintegration, how to integrate financial technologies, services from the banks in real use cases from the economy. So if we can continue with the next slide. Now, it is very interesting because, for example, okay, we have financial technology startups and fintech and digital transformation strategy for the banks. But now we can see and explore many different use cases and business models. For example, we are discussing about agri-fintech or energy fintech business model. So there are opportunities even in the Greek business ecosystem to collaborate for an active collaboration with the banking sector in order to provide these services not only related to payments or authentication services, etc., but also to support these important sectors of every economy. So we are very happy. If we can go to the next slide, in Greece, as we have supported a small municipality in Greece in order to support the local economy for the agriculture. Agriculture is one of the sectors that needs to be kept functional, and we have problems regarding mobility restrictions and for the seasonal temporary workers. So what we have developed in collaboration with a local bank was the creation of a marketplace, a matchmaking platform where we can connect the needs from the local economy with and the labor offers in order to support the value chain and the local economy. We can go to the next slide. So I think, okay, for us, the opportunities of open finance, of fintech, and the integration of and implementation of different business models is very important. We have recently launched Fintelio X in order to support, Fintelio X is a business unit from Crowdpolis, in order to support the banking sector to be more resilient and create these business cases, these financial technology business cases in different sectors. And Fintelio X is the first suite of applications. To the next, we can see how all these services can be provided. Is an integrated suite of applications where we can make and transform the banks, even the small bank or a big bank, in order to be a banking hub of services. And for example, to create services from tourism sector, to create services for transportation or for the government. So I would like to thank you, and I'm sorry if I have exceeded my time. I strongly believe that there are opportunities for the collaboration of the local community ecosystem. There are opportunities on utilizing open technology frameworks and interoperabilities. And if the banks can collaborate with startups, there are many business cases and opportunities for service co-creation, new business models, and of course, for the banking sector to be more resilient in this digital era. I'd like to thank you.
Thank you very much indeed. You've covered a lot of ground there. We've still got two more speakers, and I want to give them their due and enough time, because actually we've run over time quite a lot already. But I wanted to leave some time as well for some discussion at the end. So let's see if we'll manage to do that. So it's my pleasure to introduce our next speaker from Innovate Israel, Itai Green, who's the founder and CEO of that company, Innovate Israel. And I believe you've got some slides as well.
Hi, and thank you very much for inviting me. I would like to speak with you today about the huge opportunity for the financial industry in the corporate open innovation, which is a real opportunity during these days, which are quite challenging. So the first, in the next slide, you can see there are two types of companies during the during the COVID-19. There is one type of companies that their employees are watching Zoom in front of Zoom during the crisis, and the other one are those that are watching Netflix. They're all working at home, but those that are in front of Zoom during the crisis are really working hard and integrating new technologies during the crisis and preparing some kind of surprise to their competitors. The COVID-19 is really a huge opportunity. And the basic thing is really that there is an arrogance in corporations, an arrogance of success. They tend to think that what used to work for them in the past is going to work for them in the future. It's going to be enough. So if there is one thing that I want you to take out of my presentation is the understanding that it's not anymore, and they have to change. During the crisis, we could see that corporations with a high level of flexibility were managing the crisis much better than others which are not relying on technology. And everyone is talking nowadays about the efficiency. Everyone wants to maximize efficiency. Maximizing efficiency is only with technology. In the next slide is actually a quote that I like very much, which is the basic idea of open innovation. The understanding that most of the smartest people are working for someone else, not for you. Even if you are a bank, even which is a well-known bank and very strong and leading, even if you're Facebook, even if you're Google, it's a matter of statistics. Most of the smartest people are working for someone else. Then the lesson is to have as many partnerships, as many collaboration as possible with those smart people. And where are those smart people? They're in startups, in the academy, in other companies. So partnership is really key. Open innovation is the lowest risk with the greatest ROI as long as you do it right. And in Israel, we have a lot of experience with this respect because we have 536 multinationals which actively looking for innovation in Israel, naturally with startups. I've recently shared 10 tips, and this is the next slide, 10 tips about how to do it right, how to do open innovation right. And with your permission, I will concentrate today only on the first tip, which is the next slide. And the tip is to have a strong and real commitment from the C-level, but it's not enough. Also from the board level, from the board members. And I've recently shared an article, which is the next slide, about the ignorance of board members with regard to innovation. And this is a huge risk for the future of the companies, for the future of the banks, and for the future of the insurance companies. These board members are risking the future of your companies. And there is a lack of know-how. And in these boards, we have great board members with a huge experience in the financial business, in the business, in operations in some cases, but in many of those boards, they have no clue, the members, about the importance of innovation and technology and how to integrate these new things with the companies. And when you know better, the corporate will perform better. So the challenge is to have the board members better understand and know more about innovation and about its importance and about its value and the challenge. Diversity is the key. We have to have a diversity of professionals in the board member. It's not enough to have what we already have. We need to have also people in the board with experience in innovation and technology. We also need to have younger people. We need to have some diversity that will have more knowledge around the table, in the room. In the next slide, I want to share with you that in Israel, it is mandatory by law that in each and every bank, there has to be at least one board member who is specialized with technology and innovation. And there is also a committee which is dedicated for innovation. It's also, by the way, in other places. In Walmart, you can see that Instagram CEO joined the board. This is a simple step with a huge impact. And in the next slide, I would like to share with you that according to MIT research, when you have not one board member alike, but when you have 3 board members and more in your board who are more familiar, who are specialized with technology and innovation, the bottom line, the business performance of your bank and insurance company are gonna be better than your competitors. So I hope that at least MIT convinced you that with this little step, which is able to face this challenge that we have these days of the crisis much better. The average age of a board member in the S&P 500, and I assume it's also in your companies, is 60. And with all the respect, in 2020, it has to be lower. It has to be lower. We have to have people with a lot of experience who are older than 60, but we also have to have younger people. It's super important. And in Israel, in each and every governmental company, there is a goal to have at least 20% of the board members below the age of 40. By the way, also at Accor, the hotel chain, they have a kind of mirror board members who are really younger than the regular board members. So again, simple step, huge impact. When you have such board members around the table, suddenly the board members are thinking about innovation. Suddenly, there's an innovation budget. Suddenly, the board members are meeting startups. Suddenly, everything is moving faster. There is a follow-up, and the company share its experience during the previous quarter with its shareholders, and everything is moving faster. And in the next slide, I would like to end and tell you that this COVID-19 is a challenge, is a crisis, but it's also the best time for that rare opportunity to make a significant change in your companies. It starts with the commitment of the board and the C-level, and it ends up with some other tips that I would love to share with you later. Please feel free to get in touch with me. And exactly as I said, open innovation is a collaboration. And I would love to share my know-how and our expertise in Israel with your companies. Thank you very much.
Thank you very much for those really great insights. And we will be having some discussion, so we'll come back to some of the issues that you raised. Last but not least, our final speaker for this panel and for our event is Effie Pilarino, who is a global fintech influencer based in Switzerland, I believe. And I think you've got some slides as well, Effie.
Yes.
Okay,
thank you,
welcome.
Thank
Very
you.
great to have you.
Thank you for the introduction, and thank you, the Economist of Southeast Europe, for the invitation. And I really enjoyed my co-panelists, co-speakers, and the previous speakers too. And what I'd like to add as a final touch to all these elements and to the puzzle of how to build the resilience in financial markets, I would rather say in the economy in a broader sense. I want to speak about elements that I see globally already emerging and what needs to be done along those lines. So resilience varies, like digitalization. It varies across the region, but it also varies across the subsector of financial services. However, payments remain core to financial services, and especially during this crisis, which unfortunately came bundled. It came bundled with unemployment, it came bundled with credit and funding crunch, with disruption in supply chain and trade, and basically revealed all the weaknesses of the payment systems. And I stress the word systems because we have many systems and many cross-border payment challenges. And add on to that the fact that governments were faced with this huge bundled shock that required them to take unprecedented measures and also to transfers of wealth in order to avoid economic and social collapse, basically. So the first item that has been emerging to build resilience globally is the realization that programmable money has huge benefits. We knew it before, but now it's become of strategic importance. And that's why we see the rise of stable coins and specifically central bank digital coins, the CBDCs. So I'm not referring to privately issued stable coins, the Libra first version that came out last year and of course created a lot of hustle and bustle and threats. I'm more talking about stable coins, fiat backed from central banks. And we are seeing the emergence and the focus on this topic. We see China already having its own stable coin, the DCEP, digital currency, electronic money. It's live in a very sort of fenced way. They're piloting it in few major Chinese cities in specific sectors like transportation and health. But we also see on our side the European Central Bank looking into the possibility of issuing a euro stablecoin. Lithuania is stepping up, the central bank there, France. So add to that the fact that the BIS, the Bank of International Settlements, has taken a deep dive into the research of stable coins and central bank digital currencies. And they've set up a sandbox, a regulatory sandbox to test blockchain-powered financial services. So this is part of building resilient systems, and there's all sorts of CBDCs to be considered. We can have retail CBDCs, we can have wholesale, we can have hybrid or tiered, if you want, CBDCs, depending on what is the aim of the central bank and the government, what they're trying to accomplish with it. For example, in the US, since they used the PPP program, the payment protection program, and the aid that was given in China during the crisis, they have interest to use these stable coins, these CBDCs, to distribute and transfer wealth. All in all, I must say that this results in rethinking money, in rethinking the role of commercial banks Are we disintermediating commercial banks? In the case of China, of the DCEP, that is the case, because that coin is all about being able to do peer-to-peer payments between wallets without the need of any bank. But for other jurisdictions, this might be very different. The second element that I want to highlight and is connected to stable coins and also, of course, to building a resilient economy is the rise of interest or focus on UBIs, Universal Basic Income Schemes. During the COVID-19 crisis here in Europe, Spain and Denmark used what they call interim UBIs. Right now, in the recovery phase, we are seeing specifically Scotland being very bullish, so to speak, on implementing the UBI. We're also seeing in the US a different partnership, which is amongst 15 mayors of different US cities. And Jack Dorsey, the CEO of Twitter and Square, he's funding the initiative with $3 million to design and implement a UBI for the cities of these 15 mayors. Can we show the slide, please? I got carried away. So the two elements that, as I said, are changing what money is, programmable money, how to use it, what is the role of commercial banks, what is the role of central banks in dealing with the pure business and economic problems that are solved through these technologies. As the previous speakers mentioned, banks can solve the problem. I would rephrase that and say fintech technology deployed by whoever, whether it's banks or startups or governments or agencies, can solve business and social problems. And next slide, please. The other element that is also emerging through this crisis is that we are seeing, especially in the West, new kinds of partnerships. Before this crisis, in the fintech space, in financial services, we were already seeing partnerships between fintechs, partnerships between fintechs and incumbents, banks and insurance companies. Now we are seeing governments, central banks, regulators, agencies collaborating with digitally ready, digitally savvy private businesses. The UN is an example, GovTech and Civic Tech. Mr. Anastopoulos spoke earlier about the successful GovTech transformation of Greece. These are all examples that require a collaborative effort between the public sector and the private sector in order to extract value. And this is, again, a new element of strategic importance in building resilience in an economy and in financial services. So I would say that these three elements, the next slide, please, are, sorry, not the right order of the slides, but these elements of taking stable coins, central bank digital currencies, customized for a specific economic purpose, considering some UBI form for the transfer of wealth, and then building partnerships that are broader than the usual ones between the private sector these are strategic elements to build resilience in financial services and in economy. And I want to close with 2 or 3 sort of regional observations. One is that if we look in the East, the super app model, the TechFin model that was born and grown in the East through Alibaba, Tencent, and the collaboration with the government there, has actually been validated even more through this crisis. In the Western developed world, what we have seen is that we need to accelerate, and we already started this acceleration of GovTech and Civic Tech, and this requires the 3-way collaboration that I spoke about earlier. And last but not least, in the Western, if you want, developing markets, Africa, Latin America, and so on, what we have realized through this crisis is that even though fintech has accomplished a lot in terms of financial inclusion through, mobile money and fintech applications, this penetration has been very shallow. This realization is a tough one, but we have to face it, and we have to eradicate poverty and go deeper and use technology for this purpose. So I'd like to close with this, and of course I'm open to discuss a lot more details about these big movements or trends, if you want, around stable coins, CBDCs, UBIs, and partnerships if we have the time.
Thank you very much indeed, Effie. So everybody on the panel covered an awful lot of ground. And I guess I have to say that it's probably one of the most optimistic discussions of the impact of the COVID-19 pandemic on society that I've participated in during the past few months. So with the focus very much on the need for change and the potential of these new technologies. So we've gone over time already by about 10 minutes, but I do want to just raise at least a few of the questions that have struck me and have come in from some of the participants. But I will want to close everything by 1 o'clock Central European time. And so that gives us about 10 minutes. So what I'll do is just pose some of the questions, and then I will take you all to come in response to any of them that you choose to. Just with a few minutes, please. You really have to keep your remarks quite short, so that we can finish in 10 minutes, or 9 minutes actually it is. So a few of the questions, don't feel the need to answer all of them if you don't want to. Excuse me. Now, the first one is about Greece, and the point is being made that despite what seems to be great human capital in Greece, and obviously among Greeks working abroad as well, not least here where I am in London, Greece has been a laggard in terms of tech readiness and innovation and so on. So I just wanted to ask you all about that, why you think that has been the case. Is it perhaps because previous governments have not been receptive and not been active in terms of seizing the opportunities presented by new technology, and that Greece has therefore fallen behind? So that's one question. Why has Greece been such a laggard? And it's now an opportunity for Greece to jump ahead, and what would be the main drivers for that obviously we talked about the pandemic and how that's hastened a lot of changes. But so that's a specific question about Greece, and maybe our first speaker can come back on that. But anybody else who wants to comment on it. A second question that came in was for all of you is, I think this relates a lot to what Effie was saying at the end. Does all this that you've talked about mean the end of traditional financial services, traditional, for example, branch-based banking? You know, do you agree that that's basically going to be dead and buried by 2025, within the next few years? Or are we going to see something else happening in the way that maybe Effie suggested, that instead of this being an out-and-out competition, that it's going to develop into more collaborative relationships between incumbents and new players, and governments and digital startups and other institutions, and so on. So just how do you all see that playing out? So, you know, are the neobanks a threat, or are they actually already forcing the incumbents to change what they're doing? And the final question is, in terms of spurring change, what do you see as being most important is right now? Is it the impact of the COVID-19 pandemic, or are the other factors that some of you talked about much more important? So that's the questions. You don't have to respond to all of them, but let's take everybody just for very briefly 1 minute, 2 minutes answers to at least one of those questions. So shall we start with Mr. Anagnostopoulos? Do you want to?
Yeah, thank you. Yes, I'd like to comment. Starting from the last question, yes, I would say that it's not COVID-19, it's the issue of digital transformation in Greece. This businesses are now to do it, and yes, concerning our country, we have a lot of action, and also a concrete, I would say, national plan, a strategic plan to do so. This will be presented in the forthcoming days, and I'm sure that you'll see a major change in what Greece seems to do in the technology era. I would also like to comment on the first question. Yes, you're absolutely right. The person that has asked this question concerning the digital skills and, of course, the human capital of Greece. We are very proud to have one of the top positions in OECD. I would say ranking concerning the STEM graduates in Greece. I think that we are 6th in ranking. Needless to say that we don't take advantage of this human capital, and we have lots of people that have gone abroad and succeeded when being in UK or in other destinations. We have to do a lot more concerning the taking advantage of our human capital here in Greece, and also provide all the necessary capabilities for doing so concerning entrepreneurship and also infrastructure and stable legislation and taxation system and regulation. And I would say that in the forthcoming months or years, I'm sure that our ranking concerning both the readiness and also our position in the DESI index will much improve. This has not been shown so far because the latest rankings concerned data up to September 2019. I think our position in the DESI index will much improve in this year's rankings. And the second question referred to the potential or imminent change of the banking system, and also the I just want to say that concerning the human-centric approach and capabilities, the same stands for public administration as in the banking sector. I think that we have to provide tools and capabilities both for people who are in the technology era much more concerned and capable, and also provide for the ones which are not. And thus expect that both traditional ways for interacting with citizens and clients will pop up in the near future, as well as provision of much more modern and extensive capabilities be the direction that we have all to move on, and let the ones who can take advantage of such capabilities do so. So that's my position in these issues.
Thank you very much indeed. Mr. Karamanolis?
Yes, I would like only to mention that government initiatives regarding digital transformation or the development of skills for the public sector, etc., are very important. Also, they develop the demand for digital services. When you have the demand and the overall digital culture of a society, I think there are great engineers in Greece, technology startups, in order to respond to this demand. Yeah, this is one thing. The other is that, okay, of course, you have to provide at the government level, have to be provided more incentives related to technology based startups. And I think the government is working on that. And there are a lot of instruments announced recently. I strongly believe that two are the basic pillars of technology, entrepreneurship, and digital transformation in Greece. From the startup aspect of the conversation, the government initiatives play a great role. The provision of open data from the government is also a critical success factor for the technology startup ecosystem. And of course, the collaboration and incubation and acceleration with by the banks of new startup technology startup companies is also important. It's something that could improve the internal processes of the bank. It's something that will bring innovation and more opportunities for the local tech ecosystem.
Great, thank you very much. And Mr. Green?
I will be super concrete and short. Pass a law by the end of the month that as of Q4, each and every corporate with over 1,000 employees in any industry, including the financial sector, has to nominate 3 board members who are specialized with technology and innovation. And I promise you, you'll see the results in 2021. This is the fastest way to implement it around all the companies. This is the first tip. There are 9 more, but we don't have time.
Okay, thank you very much. And finally, Effie?
So I have a great idea that you all inspired me, Mr. Anagnosopoulos and Mr. Green. Why not pass a law in Greece where every Greek company has to have on their board one Greek person like myself that is living abroad and is tech specialized, and that becomes a requirement, and that way we transfuse all the knowledge and the passion that we have for our country in a very quick, remote way. And in the meantime, we also work on building an ecosystem and a network here that can bring us all back. But that is something that can be done immediately.
Okay,
Mr.
thank you very much.
I leave the idea with you.
Why not? I concur. Yeah.
Yes.
Of course.
So we had
You're
some very,
absolutely
very practical advice and tips there. So let's see if they get taken up in the next few weeks and months.
Okay.
I'd like to thank all the speakers on this final panel and all the speakers for their participation in the whole event, in our 3 panels. It's been a great discussion. It's been great to have you with us. I would also like to thank all our sponsors who helped to make the event possible and have been very important in making it happen. And that is Innovate Israel, Guarantee BBVA of Romania, the Alba Graduate Business School, Wind, Aegean Airlines, Qantas, Avritron, Pobutsa, DHL, and HMI and partners. Thanks to all our sponsors, thanks to all our speakers, and thanks to everybody who joined us for these very important discussions today and for your questions. So that's it from me, and thank you, everybody. Have a great day. Bye.
Thank you.
Bye.